Okay, so now we're moving on to part three, which is where I take a look at the macros. Again, that's so important as far as I'm concerned. There's a lot of people out there that are technical traders. They don't bother with the macro at all. Charts are their rule. They just whatever the chart says is what they do. Of course, sometimes they win, sometimes they lose, but that's just part of trading, no matter how you're using or what you're using to trade the markets. But for me, I like to include the macro because it gives me that longer term view of where markets should be heading. Of course, it does change from time to time, and in the last 2-3 years, it's changed very quickly at times. But it does sort of help you to understand what's going on and what to expect. Because sometimes you can get a small trend happening within a much larger trend. So when we look at the macro, the markets remain nervous, although, when you look at the stock markets, they're incredibly strong, which, may be a little bit surprising to many. And of course, the US data is really making the markets fly at times. And then, of course, just remember that risk management when you're trading. But inflation seems to have stabilized rather than anything else. Okay, it's not racing up anymore, but it's definitely not dropping down to, where the central banks want it to be, their target 2%. It's not jumping yet, but, there's always those risks that some of that does come back, that inflation, because energy may start to gain momentum again after OPEC plus is still trying to force prices higher with cuts and such like, and of course they did that last week, and of course that really got oil finishing the week strong on, it was over $73, almost $74. So it did have that end of week flurry there, big rally. And of course, the question is, will it continue next week? Are we going to see a new range? Agricultural products too, okay, some of them weaker, some of them stronger, but there's potential for a lot of them to move higher, with Russia unlikely to renew the Ukraine sort of export corridor that they have allowed in the last 7-8 months. I mean, it's amazing, isn't it? The war's past 500 days now. But Ukraine continue their counter-offensive. They're getting still getting sort of kitted out again by other countries with some very good weapons. It's just a shame that it's happened at all, and it's a shame that it's continuing and so many lives are being lost. But Ukraine is doing sort of fairly well with their counter-offensive. They're regaining ground. Obviously there's a lot of concerns over what Putin could do next, and that sort of the nuclear power station that's supposedly got loads of explosives plastered all over the roof as well. So moving on, again, still sort of on this China and such like is, we may start to see them coming back in now. Everyone expected the moment they reopened for demand to fly up, but of course that was much more focused on sort of named goods and all that, not so much on the country, because they stockpile so much. But we're sort of 6 months into that now, that reopening, so we could see that they're starting to begin to drain down some of their stockpiles. And that may bring them back into the commodity markets to replace some of them. As I constantly discuss, I still believe that the US has the best economy, and that because of that, they could still get away with a soft landing despite the aggressive rate hikes that they've done. That is one point. The other point to that is, I don't see the same situation in Europe. I believe that they're going to enter a deeper recession, and probably a longer one too. And of course that does include the UK, where I'm based. remember, this is just my sort of outlook, my expectations. Now, I mentioned this earlier, but for me, traders are way too focused just on rates. You've got to appreciate the macroeconomics that's going on in the background that really sort of gives all these markets their values, and just have a look at that bigger picture. And of course, when you take a look at that bigger picture, then it starts to give you more of an idea of, not just what's happening today or tomorrow, which, some of you, that may be all you're interested in, but, what's going to happen in the months ahead, because that ends up giving you a bias on your expectations and, the positions that you take on. Again, the dollar ended quite a bit weaker on the end of the week. Me personally, and this is not a recommendation, but for me personally, I'm getting ready to buy put options on cable and the euro against the dollar. I just don't think that Europe deserves to be recovering currency wise when they've got so many problems ahead. But again, that's just purely my view, so be careful there. And the 10-year US Treasury yield managed to get above 4% again on Friday. Now, coming back to the UK, so yeah, inflation may be dropping a little bit, and price growth for the next year is sort of expected to be below 5%, but that's still way off the Bank of England's target rate. And the public are still suffering from all of this. On the other side of that, I suppose, you can look that wage growth is going to match that. It could even be slightly higher, around about 5.3%. And that lack of workers, I'm talking about the UK here, that we've sort of been focusing on over the last couple of years. It's now around 29%. This is sort of where companies are struggling to get the workers, about 29% now, where it was averaging around 50 to 60%. And in the UK, CPI expectations are expected to around 5.7%. Again, it's still too high. Either the central banks realistically need to increase their target expectation rates to 3% or something, or they what do? If they can continue to put rates up, but are they effective? For me, the thing that impacts demand more is price. So if the shops, the providers, the suppliers are going to keep putting their prices up, they're just going to sell less and less, because okay, how much disposable income, how much are people eating into their savings? Can people keep asking for a rise? Are the employers going to actually give them to them? All of these are questions that need to be asked, and again, this, where we're looking at the bigger picture. It always comes back to sort of how this inflation was triggered in the first place, and of course that was from supply chain issues. After COVID there was just a lack of everything, and that's just continuing. I mean, it's much less now, and if you look at the costs of raw materials and such like, many of them are now back below that sort of pre-COVID level, pre-war level and such like. And of course that Russia-Ukraine thing is still going on. Hopefully there's going to be a solution soon. OPEC, they're having a little bit more success than they have on their last couple of meetings. And oil towards the end of, on Friday almost touched $74 for WTI. So whether that will continue this week or not, I don't know. And of course, again, when you look at the macro, you've got that balance of, okay, supply, they're trying to reduce supply to force prices higher. But on the other side of it, if demand keeps weakening, then that's offset against that shortage. So it's just a balance. And of course, that food inflation is still with us. I mean, you still see in the shops, a lot of costs have come down for the majority of companies, but you're not seeing that in the supermarkets in any way, shape, or form. And as I keep saying, buy local, buy from your local suppliers rather than these big suppliers. Give those guys a chance. So that's about it for the macro outlook. There's again is our list of services, which I'm sure you should know by now, but if not, then just take time. Just feel free to reach out to us and ask us any questions about what we do provide and how we can help you. We will happily get back to you and offer you solutions. Okay, so now we're going to move on to the final part 4, where I'm going to be speaking and analysing a variety of markets.